the accounting principles which are generally accepted or widely accepted by the accounting practitioner. Separate entity concept means maintain a separate book for the owner as well as for the business. The total accounting principles are classified into two categories: accounting concepts and conventions. While depreciating your assets or while calculating depreciation, consider the cost value, not the market value. Hello everyone, I am Meghana from the Department of Commerce, lecturing in Vidhyaashram First Grade College, the Temple of Excellence. We are in the session 3 of Unit 1, subject Accountancy. In the last session, we have discussed about some accounting terms. In today's session, let us start with the introduction to accounting. In today's session, let us discuss with the concepts and conventions of accounting and accounting standards. First one, accounting principles. According to American Institute of Certified Public Accountant, that is AICPA, an accounting principle is a general law or rule adopted or preferred as a guide to action, a settled ground of business conducted or practice. That is, according to American Institute of Certified Public Accountant, accounting principle is a general law or rules adopted or preferred as a guide. So it is a set of law or rule. It is preferred as a guide. It's preferred as a guide for the settled ground of business conducted or practice. That means it is a set of law or rule. It is preferred for the business or organization to follow in their accounting procedure. So it acts as a guide. Generally accepted accounting principles. GAAP. Accounting principles which are widely accepted by the accountants are known as generally accepted accounting principles. So GAAP means generally accepted accounting principles. The name only says generally accepted. The accounting principles which are generally accepted or widely accepted by the accounting practitioner or widely accepted by the accountants is known as generally accepted accounting principles. So from this set of rules and regulations, so some of the or set of accounting principles which are accepted by the accounting practitioner or accountants is called GAAP. In other words, generally accepted accounting principles are set of guidelines and rules which are widely accepted by the accounting practitioner, at a given time. So, from this general law or rule, the set of rules and regulations which are widely accepted by the accounting practitioner. So, it is useful for the organization and it is easy to follow the rules. That set of rules and regulation, the widely accepted accounting principles are called as generally accepted accounting principles. So these principles are accepted by the accounting practitioners at a given time. So this is accounting principles and GAAP. Next, accounting policies. Accounting policies are the specific accounting principles and the method of applying those principles that are considered by the business enterprises to be the most appropriate in preparing and presenting the financial statements. So, accounting policy or the specific accounting principles. Now, we know the accounting principles. Accounting principles is the general law or rule. So, out of general law or rule, specific accounting principles. So, out of accounting principles, any one or a specific principles which is benefited for the organization. So, the specific rules and the method of applying those principles. So, how you can apply those rules in your accounting procedures. Then, applying those principles are considered by the business enterprises. So, it is convenient for the business enterprises. So, for the business enterprise, they consider some of the accounting principles, specific rules, which is convenient for them to maintain their books of accounts, to prepare and present the financial statement. It became easy. So, those rules is considered as accounting policies. So, from the set of accounting principles, a specific accounting principles and method of applying those principles is considered by the business enterprises to be the most appropriate while preparing and presenting their financial statements. That is considered as accounting policies. Next, Classification of accounting principles. So this accounting principles are classified into two types. First one, accounting concepts and accounting conventions. The total accounting principles are classified into two categories, accounting concepts and conventions. So accounting concepts are further divided into subcategories. The important accounting concepts are this 10 concepts. Under that first one, money measurement concept. According to this concept, money measurement concept, it says accounting. When you are preparing accounting, you need to record all the transaction which can be measured in terms of money. So here, accounting money measurement concepts. So the transaction which can be measured and expressed in terms of money or money's worth, those transactions should be recorded in the accounts, in the books of accounts. So mainly we prepare the accounts in order to know the profit or loss earned or suffered from the organization. So in order to know the profit or loss, we require only the monetary transactions. Non-monetary transaction will not affect on the company's profit or loss. So you need to record only the monetary transaction in the books of accounts. So according to this concept, you need to record only the monetary transactions. Next, separate entity concept. Separate entity concept means maintain a separate book for the owner as well as for the business. According to this concept, even though owner, he runs the business and he starts the business, but the owner is separate from the business. Owner and the business, it's two separate entity. So maintain the separate account for the owner as well as for this business. So owner personal expenses and the business expenses is not same. You're not supposed to record both the transaction in a single book. So if the owner earns profit or if the owner earn any income from different source, means it is belongs to owner. It belongs to owner. If the company earn profit, means it belongs to company only. It is not the profit for owner personal purpose. So here you need to maintain all the incomes and expenses of the owner as well as the enterprises business in a separate book. So maintain separate book for the owner as well as for the business. So it says maintain separate books for owner and business. Owner and business are two separate entities. Next, going concern concept. Going concern concept means while preparing the accounts, you need to consider the account or the company, the business is going to continue for a longer period. So while preparing the accounts, just keep in mind your business is going to continue with for a longer period, so that take a account for the futures. For example, debtors and creditors. So debtors and creditors means you are going to receive in future. So you need to consider those factors in your accounts. Your business is going to continue for a longer period. A going concern means you need to prepare your accounts with the intention the business is going to continue for a longer period. Next, cost concept. Cost concept means while recording in the books of accounts, you need to consider the cost of acquisition. Cost of acquisition rather than the market value. When you purchase any goods or material, just record the cost value, not the market value. For example, if you purchase a machinery for your business, so machinery value is 1 lakh rupees. Machinery market value is 1 lakh rupees, but you purchase for 80,000. But you purchase for cost. Purchase value is 80,000. So you know the seller, or with the bargaining power, you will purchase the machinery for 80,000 rupees. So in this case, the cost value, at what price you will purchase the goods. So you need to record the cost value, not the market value. So consider cost value when you are going to record the purchase or any transaction in the books of accounts. So use this amount for the further calculation. While depreciating your assets or while calculating depreciation, consider the cost value, not the market value. Next, dual aspect concept. Dual aspect concept means two aspects. Dual means two aspects. You need to consider while recording in the books of accounts, you need to prepare with two aspects. That means when you are selling goods, means one must be a seller and one must be a receiver. So here two parties are there. So you need to give effects for two parties. One must be a receiver and one must be a giver. The receiver and giver should be treated, or it should be affected in the books of accounts. You need to record both the receiver and giver in the books of accounts, so that whenever you want the information from whom you have received or for whom you have sold the goods, sell the goods, means you will get it from their books of accounts. So dual aspect means give effect for both the receiver and giver. For example, if you purchase the goods, means you are the receiver of goods. So you need to record the receiver as well as the giver. That means from whom you have purchased. So that you need to record both the receiver as well as the giver. One must be a receiver and one must be a giver. At least two parties should be affected in the books of accounts. Next one, accounting period concept. Accounting period concept means one financial accounting is further divided into convenient accounting period. So based on the requirement, based on the organization requirements, you are going to divide the whole financial year into subdivision. Either it may be for quarterly, half yearly or yearly. So divide the whole financial year into convenient period. So convenient accounting period. So in that convenient accounting period, you are going to evaluate your position, so that if there is any necessary for the changes, so it acts as a caution. So it shows you are in loss, means you can take a necessary steps to overcome from the losses. So in order to know the financial position for a short term period, you are going to divide the whole period into sub period or convenient period, so that you are going to evaluate regularly. So this concept is divide the whole financial year into convenient period, so that you can evaluate your performance regularly. Then objective evidence concept. Objective evidence concept means for every transaction in the books of accounts, you need to record all the business transaction or all the business transaction which is related to monetary term. So all this transaction should be have some evidence. That means bills, invoice, vouchers and bills, it should be subject to evidence. So you can verify. Chartered accountant or any auditors, it should be able to verify from the chartered accountant or auditors, so that it should subject to evidence. You should have the evidence for your transaction. For the purchase, you should have some purchase bill, sales bill. So you should have the bill, invoice and voucher for the transaction. Then revenue realization concept. Revenue realization concept means you will receive some advance. So from the purchaser or from the customer, you will receive some money as an advance before rendering the services or before transferring the goods. So you should not consider that amount as a revenue. So revenue means when you earn the money or when you earn the income, then only you will consider it as a revenue. But before earning, before realizing, you should not consider the revenue as realized. Even though you will receive the money, but it is not considered as realized. So at the time of goods transfer or the ownership is transferred, after transferring the ownership from the seller to the buyer, then only you need to consider the money as a revenue realized. Then only you need to consider revenue as realized. So until then, you need to consider outstanding income. So before rendering the service or before transfer of ownership, any revenue, you will not consider it as a revenue realized. So after rendering the service or after transfer of goods, then only you need to consider the revenue as realized. Next, accrual concept. Accrual concept means you will render some service or you will transfer the goods to the buyer, but you are not received the money. In this case, you will consider as income accrued but not yet received, because the ownership is transferred from the seller to buyer, but income is not yet received, but in future you are going to receive the money. So this income is accrued, income accrued but not yet received. So you treat this amount as a income accrued. So if the service is rendered or ownership is transferred, then you can consider the income as income accrued. So income accrued, you will treat the amount as a income accrued. Then matching concept. Matching concept means all the expenses and income. Now you will record all the transactions. So now you know the expenses and income. So match the expenses with income. So match the expenses and income. If the expenses is more than the income, then you are in loss. If the income is more than the expenses, you are in profit. So match both the income and expenses. You will get to know the profit earned or loss suffered from the organization. So you need to match all the revenues and expenses. So matching concept says match the expenses, compare the expenses with the income. So this is all about accounting concepts. Next, accounting conventions. So the accounting principles is classified into two types, accounting concepts and accounting conventions. The important accounting concepts are this 10 concepts: money measurement concept, separate entity concept, going concern concept, cost concept, dual aspect concept, accounting period concept, objective evidence concept, revenue realization concept, accrual concept and matching concept. Then accounting conventions. So accounting convention is 4 accounting conventions. You have 4 accounting conventions. Under that first one, conventions of materiality. Convention of materiality means no need to record the detailed information for each and every transaction. For example, in organization, they'll purchase pen and pencil for their office work. So, at the time of usage, when you're using the pencil continuously, it reduces its value. So, when you're using any material, it loses its value. So, you need not to record all the transaction or the detailed information. So, day 1, the value of pencil is 5 rupees. So, day 5, it reduced to 3 rupees. Its value will reduce to 3 rupees. So, no need to record the detailed information. So, no need to record the detailed information for all the transaction. Convention of materiality says no need to record the detailed information for all the transaction. So, when it is necessary, just give the detailed information for such transaction. Then conventions of conservatism. Convention of conservatism means the whole accounting period is divided into convenient accounting periods. So, you are going to evaluate continuously, you are going to evaluate your performance. So, after evaluating your performance, you will get to know whether the organization is in profit or in loss. So, if your financial position says if you are in loss means take it as a caution. So, take it as a caution, take the necessary steps. So, through this financial year, you can overcome from the losses. So, take the measure to overcome from the losses. But if your evaluation says you are in profit means just ignore the profit. If you are in profit means just ignore it. If you are in loss means then you will take it as a caution and improve your transaction or improve your efficiency. So, if profit, ignore the profit. If you are in loss, just take it as a caution. Next, convention of consistency. Convention of consistency means maintain consistency in your accounting procedures. So, when you are recording the transaction, when you are maintaining your books of accounts, maintain consistency. For example, depreciation. Depreciation. You have various depreciation, various types of depreciations, straight line method, WDV methods, and many types of depreciation are there. So, if you are maintaining the straight line method of depreciation for 1 year means you need to maintain the same method for the rest periods. For the remaining period also you need to maintain the straight line depreciation only. So, you should not change the method of depreciation. 1 year you will maintain straight line method. Next year you will switch to WDV method. Again you will switch to straight line method. So, don't switch from one method to another method. So, maintain consistency in maintaining the books of accounts. Next, last one, convention of full disclosure. Convention of full disclosure means you need to give detailed information for the person who require the information. For the user of such information, you need to give detailed information. For example, in the balance sheet, you will record debtors. So, you will write debtors amount is 1 lakh rupees. This 1 lakh rupees is for total debtors. Out of this debtor, how much is good debt and how much is bad debt and doubtful debt, then provision for bad debts. So you need to mention all the detailed information so that the investors or the creditors will get to know the information about your financial position. So don't mention 1 lakh rupees. So give detailed information for the required users. So it says disclose the information, full information for the required users. This is all about accounting conventions. Next, accounting standards. So accounting standards, Indian accounting standards, we have Indian accounting standards. It's a guide for the organization to maintain the books of accounts. The list of accounting standards formulated by the Accounting Standard Board of India is as follows. We have some accounting standards given by Accounting Standards Board of India. So just look at the accounting standards. AS1, disclosure of accounting policy. So you need to disclose the accounting policy. So which is accounting policy followed by the organization and the method of applying those policies. Then valuation of inventories. How you are going to evaluate your inventories. You need to disclose the information. Next, cash flow statements, cash inflows and outflows. In a financial years, total cash inflows and total cash outflows. Then contingencies and events occur after the balance sheet date. So some of the transaction will occur after the balance sheet date. So you need to mention all these events. The net profit or loss for the period. So mention the net profit or loss for the particular period. Next one, depreciation accounting. So depreciation, method of depreciation. So you need to mention the method of depreciation and how you are going to calculate the depreciation. Next, AS7, accounting for construction contracts. So accounting for construction contracts. So how you are going to plan. So this you need to mention the construction contracts. Then revenue recognition. So revenue, revenue recognition. So you need to mention all the detailed information. Next, accounting for fixed assets, total fixed assets. You need to mention the fixed assets. Out of the assets, total assets, how much is the fixed assets. So what all are the fixed assets? The amount for particular fixed assets. You need to give detailed information. Then accounting for the effect of changes in the foreign exchange rate. So foreign exchange rate, changes in the foreign exchange rate. You need to give account for the changes in the foreign exchange. Then AS12, accounting for government grants. So for the government grants, you need to give accounts. So you need to give accounts for the government grants. Then accounting for investments, total investments from the company. Then accounting for merger and amalgamation. So you need to give detailed accounting information about the amalgamation. Then accounting for retirement benefits in the financial statement of employees. Retirement benefits in the financial statement of employees. So you need to give information about the benefits. Then borrowing cost, interest rate, all this you need to give information. Then AS7, segment reporting. AS18, related party disclosure. So you need to give disclose the related party information. Then leases, about the leases. Then AS20, earning per share, EPS, earning per share for the equity share holders. Then consolidated financial statements. You need to give consolidated financial statement. AS22, accounting for tax on income. Accounting for tax on income. So the total income and tax paid by the company. Accounting for investment in associates in consolidated financial statements. So here in consolidated statements, the accounting for investment. Then AS24, discontinuing operations. So for all this, you have a set of rules and regulations. Then account AS25, interim financial reporting. The AS26, intangible assets. You need to give the list of intangible assets. Then financial reporting of interest in joint venture. Next 28, impairment of assets. Then last AS 29, provisions, contingent liabilities and contingent assets. So you have AS 29, total accounting standards 29. This is all about today's session. Let us meet in the next session with some more topic. Until then, keep watching. Thank you.